Data Patterns is a defense and aerospace electronic solutions company. In their own words, at the end of Q2, their current quarterly performance is one of the best in the history of the company, I presume, when it comes to the second quarter performances, and has surpassed their internal targets. This comes on the back of a fairly strong Q1 as well. In order to get a sense of what's working for the company and what the outlook could be like, we got with us Mr. Srinivasagopalan Rangarajan. He's the Chairman and Managing Director of Data Patterns, joins us right now on the show. Mr. Rangarajan, good having you. I hope all is well.
Thank you. Yes, all is well. Right.
So after a strong show in Q1, I believe revenues were up 84% YOY then too. This is about 49% growth, which is strong, and I presume the best ever second quarter for you in your history. What is clicking?
You see, all along, this business has been a Q4 business all along for us. Before going public, we said, we need to do this on a quarter because this is what is expected in the market. So there has been a change. Is how do we do this? So one thing happened is that we had an order book. Earlier days in the development contracts mode, we are actually working order to delivery on the same year or next year. Today, I have a visible order book for 1 or 2 years or 3 years. Some of the contracts are 3 years. So this allows us to plan our order and execution accordingly, quarter to quarter. And also customers, other than production, production orders, they also want quarterly delivery. So it evens out some of the delivery over through the years. So this is exactly what has happened the last 2 years. We started to try and do quarterly sales, and that is what is picking up. And two things are contributing. One is the order book is growing. So the revenue size itself is growing 30-40% year on year. And so that is also pushing up the quarter-to-quarter sales. On top of it, trying to also even out the quarter-to-quarter sales. So that's what you see in the graphs in front of you.
Okay. How does this... okay, let me first actually talk about the quarter, then we'll move on to the nuances for the slightly longer term. EBITDA margin for the quarter was 34.2%. If I'm not wrong, the first half is 32.8%. So it's inching up, not quite around that 40% mark that I presume you had probably thought of for FY23. While you remain a Q4 company, do you reckon it can be so strong that it can average out to 40% for FY23?
Yes. See, what happens is the EBITDA, the overheads remains the same. Our revenue is not evenly done quarter to quarter. So when the revenue starts going up, EBITDA starts inching up. So on the year FY23, we still maintain 39-40% is the EBITDA which we projected last year is what we'll do. We will do that this year also.
Which means you kind of need to do 46-47% on average for the second half.
We will do that. We know we will do that.
Got it. Okay. So while the P&L numbers look good, cash flow from operations for the first half was a negative 72 crores. Now, you did mention during the con call, as I read out, right, that you're holding higher levels of inventory given that some components have higher lead time for delivery, etc. Is this one of the reasons? And how would this unravel if it does in the second half?
See, we are having issues on delivery of components. What we ordered last year, September, we still not, some of the components not received today. So some of the shipments which we wanted to do, we are not able to dispatch. So we're juggling with shipments. What we can deliver ahead, we're trying to do that. That's what actually we're doing today. So the important thing is to deliver on whatever our contracts we've taken. So we are buying up a lot of materials. Not for this year, we're also for the next year. We're buying materials as a stock and stocking it. Because sudden disruptions in delivery will affect our own performance. So component stocks are going up, but this is a temporary phenomenon. As and when they stabilize, the procurement happens as per projection, then we will automatically tune down the inventory buildup.
Okay, so from 141 inventory days for FY22, it's inched up to 175 odd. You are hopeful at some point of time it will go back to those 140 odd levels?
Yes, we're hopeful. But for the time being, we're not focusing on it now. The important thing is to deliver the growth. So that is the focus area today.
Okay. And what about debtor days? Those two from 233 odd days for FY22 have inched up to about 246. I presume when the only buyer, so to say, or one of the major buyers, so to say, is the government, it would typically happen. What's the sense? I mean, would the debtor days stay at these levels, or are you hopeful of improving them as well?
It would come down. It actually, we expect it to come down with more production percentage of delivery than the development deliveries. However, what happened the first time, we are actually delivering radars to the user directly, our own radars. So initial understanding of how acceptance happens, etc. There is a learning curve in this. So, but we've already delivered. First radar is accepted. So second one, we expect acceptance to be faster. So this is early days. So as we learn on the delivery process and acceptance process, our data days will start coming down. And since it's all new, this is all taking a bit of time. But we expect to come over this very shortly. So the overall working capital days itself will come down. In the next medium term, you find it will start coming down from where it is to manageable levels. But we don't have any bad debts as such. It's only extensions on collections, which will get reduced as we go along.
Mr. Rangarajan, give me a sense of how do you expect the buyer side to get developed over the course of the next 2-3 years? When I speak to fund managers, and specifically on radars, right, they say that the radar production capability of Indian companies has gone up so much that now, forget importing, but there are companies which were erstwhile making their own outside, countries which are making their own radar systems are importing from Indian companies as well. What's your sense of how is this ecosystem getting developed? Can Indian companies like yours make a telltale mark on the export side as well? Give us a sense.
Yeah, I wouldn't go so much there. See, what has happened is, in India, we were never allowed to build full systems. We were working with subsystems with DRDO. And that is how the market was. And the large PSUs also were doing transfer of technology and manufacturing it here. It's more a manufacturing organization than a design-centric organization. The only design-centric lab was DRDO in an Indian context in defense. And Department of Space was doing their own design and tracking radars. So having not done that, suddenly you cannot say, I will develop the radars myself. So it takes time. So, and then say world-class radars. It also takes time. So what we have been doing over the last 14 years is wanted to build up a competency of building the entire radar ourselves. So it has taken a number of more than a decade of being in this business, actually developing all the subsystems of radars. Then we took up upgrade of radars for ISRO to build the competency of how the domain can work. And then when MOD and other people and, weather radars and things like that opened up in the country, non-defense radars, we built the full radars ourselves. After that, we went into defense. So it has taken time for us to do this. Today, we are the only company who have designed complete radars in India. And that is the truth. So having done that, now we want to expect to look at why don't we build the full radars in Indian context with the ecosystem. This is the main game which we want to do. We want to build the sensors in India. Rather than people importing sensors, or manufacturing with partnerships, which is what Indian companies are doing. We want to be different. We want to say, why don't we compete with the foreigners and build our own systems here? So our game is different. We start ground up design and build it. It takes an enormous time, but we have started building it now. We won the first contract, which was precision approach radar. We won 380 crores from MOD. This is a fully designed radar in India, which we deployed for trials and won the trial. So that we started delivering now. This has given us confidence to start to build more systems. So we are trying to do electronic warfare systems and radars, etc., trying to build end equipment ourselves. It's a long-term game, but I think, yes, it is going to be there. And on the buyer side, if you say user side, this Def Expo was a very different Def Expo in the sense we had in Gandhinagar a few weeks back, in the sense that because of the Indian government's, restriction of you can't import, you do make it in India, 50% value add in India. Almost all of the service officers, the users are looking at Indian vendors to see how do we address their need, because there is a budgeting requirement of capital equipment and upgrades. Now, how do we address this with it just done in India? So they also have a problem at hand. So they're really looking at how we can work with Indian industry to do this. So it was a very welcome kind of meetings which we had. I think looking at the way they are looking at the problems, in the medium to long term, there is a substantial potential to scale. As long as we build competency and products which meets the world class and meets the user expectations.
No, so I'm just trying to understand. Are you saying that just the B2G, which is just the Indian government order fulfillment, is good enough for you to scale up substantially? Or would you look to diversify and export some of the stuff that you're making as well, if not already?
Okay. See, the size of business growth is expected in Indian context. If once you look, India looks inwards. It's so big. You don't have to look outside India at the present moment. But having said that, we have got an opportunity with what we've done, precision approach radar, which we developed in India. There's an opportunity which to sell it to a NATO country. We have quoted. It looks like we are lowest quote. So once the contract comes, we'll be announcing it that some portion of it probably we will do for a European company also, our country also. So we are looking at outside, and looking at collaborations outside and see what to do. But I'll tell you, the growth model has to come from within. See, India has imported everything. When that kind of things looks inwards, it is an opportunity is immense. It's very huge.
Okay. Now, one last two questions, one on order inflow and one eventually on the revenue growth. So your order inflow, I think, looked very strong. If my numbers are not wrong, highest ever order inflow in a quarter. Now, give us a sense, while this quarter may have been largely around development contracts, how do you envisage your company to look like in terms of division between development, service, as well as production contracts?
See, we were thinking last year that in development contracts becoming lower and production contracts becoming larger, and that's weighing well for the company. But when you want to build scale, we suddenly surprised that some large development contracts for entire radars were outsourced. These were space surveillance radars, which you could look in deep space. And they said, we will look at very smaller, 1/20th of the size. He said, let's build it in India itself. We won both the contracts. But that is just a marker starter. Once we deliver the contract, the radar fully, this will be 20 times size, a few thousand crores per radar. Largest radar India has ever designed or looked at or installed. So we expect that that is a business we want to be in. So we aggressively quoted, got the contracts. That is in a delivery model, development model now. We deliver next year. Year after next, we expect the scale to happen. So that is one of large orders. But the development contract, production contract is still happening. We have delivered a number of orders where we have created a pipeline. Once that is converted into production orders, the orders will start coming in. More than a few thousand crores of pipeline we have created on data patterns designed products. We expect that to start conversion in the coming years.
So does the mix change, or do you reckon it will largely remain the same?
It has to change. It has to be more production, less development is how it has to go. Because once you develop a few pieces, then hundreds of pieces are bought later. So obviously, as a percentage, development value, it has to be less than the production value.
And is that more margin accretive?
Margin between whatever we have done, see, we don't actually charge for development costs. We absorb the development costs during development stage. So the margin remains almost same. Only thing is, we write off all the development revenue in the P&L on the year on which we deliver, which is then not there for the subsequent years, and the volume comes. So the margin on gross margin typically tend to remain the same.
Got it. Okay, now final question, Mr. Rangarajan. You've done exceedingly well in quarter 1 and quarter 2. And by your own admission, quarter 4 is largely the strongest quarter. Yet you guide to a 20-25% top line growth. I understand being conservative is a virtue. Is this being too conservative?
See, what we're trying to do is, looking at the overall numbers and let us see, reduce the quarter 4 picture is what we're trying to do. And we're attempting to do that quite well now, as it looks like. It is not always going to be there. If we have the flexibility to do that, an order book and a delivery style which is matched, I can do that. But yet, quarter 4 still remains larger. So maybe we may land up doing better than whatever we giving the estimates have been given. But we'll retain the estimates for the time being because there are issues in component delivery. So we need to see that if there are issues in component delivery or incoming component, so then we need to mitigate that. So let's see how it goes. As long as we retain the numbers and exceed it, it's good. So we are trying to do that.
In order for you to retain the numbers, you need to do really badly in quarter 3, Mr. Rangarajan. So that's my question, really. I mean, you want to target 20-25%, but seemingly FY23 will be a stronger revenue growth number anyways.
I believe so. But let us do our mathematics internally and come back.
Fair call. Maybe we'll talk at the end of quarter 3 to understand if you're revising this upwards for FY23. I'm not talking about CAGR numbers, but congratulations. Keep up the good show. And yeah, I mean, it's lovely to see Made in India getting splashed across. So please keep up the good work.
Thank you very much.
Thank you for talking to us today, and viewers, thanks for tuning into this conversation.
Thank you.